What we propose to deal in next couple of hours or less than 2 hours would be one significant amendment. The budget which we saw in terms of the Finance Bill 2023 was largely a taxpayer-friendly budget. In what sense it was taxpayer-friendly budget is that no change is a great change. Let the business do what they want to do rather than keeping on tinkering with certain provision concern. Last 3 to 4 years, there have been no substantial change except that TDS provisions went for a complete revamp. Nonetheless, this was a great provision, a great budget as we would have believed. What came as a significant surprise was the increase in FTS and royalty rate. Since this has an impact in terms of cross-border transaction, I am sure that with this intent, Kirit Bhai and his team would have decided to take this up as a topic, as a principal topic. With this, I do propose to cover some of the other tertiary issues which are equally linked but in a different way. The 10F digitalization, which seems to be a new tool for litigation. The provisions relating to tax residency rule and then other implications which will follow from this increase in TDS rate. Now, what we saw was that erstwhile, that means prior to 1st April, and Chaitanya, a small request, if voice is not audible, please prompt. I'm just using some Bluetooth machines and speakers. So just please prompt. I would just immediately switch it off and go back to the original mode. So therefore, what we saw prior to 1st April 2023 was a regime where 10% under 115A was the TDS rate. What we were told was that apart from that, you go back to the second schedule, which we find typically in the last pages of the Income Tax Act, and add it up with the applicable cess and surcharge. End result broadly was a domestic rate of 10.4% and or a 10.92% at a higher level. Net sum and substance 11% was the peak rate as far as FTS and royalty was concerned. Law of business, law of contracts were concluded, and what one felt was that this is the rate and there are no changes as far as the broader tax rates are concerned. What came subsequently as a shocker was a last-minute amendment at the time of passage of bill to an act, where without any further reason, 10% rate was immediately increased to 20% rate. And this is the reason for which this particular presentation has been organized. Now, it's not that first time there has been a change of rate. One needs to go to legislative history and one needs to see as to which period and what perhaps could have been the reason. This is because it is likely to impact cash flows of certain transactions in a big way. As we move forward, one will also see that there are certain issues which are not settled at this moment. Which way the view courts will take, one does not know. So if you are on the wrong side of the wicket, knowingly, unknowingly, after taking all the care and the discretion concerned, still you would be hit by a 20% tax rate or a 20% bracket. P. Chidambaram, 1314, made an amendment and increased 10% to 25% by putting certain reasoning. This is from the budget speech concerned. What was told to us was another case in the distribution of profits by a subsidiary to the parent company is in the form of royalty. Now, friends, in financial year 13-14 or in the budget 13-14, there was a DDT era in there. A DDT rate in any case was starting from 20%, was on the upside of 20% on those cases. So there could have been strategies. There could have been a case where some profits would have been shifted in the form of royalty or FTS concern. In the times where we are, it's again into a classical way of taxation. Dividends are taxed in the hands of shareholder. If you are a non-resident company, there would still be a treaty which will come into the rescue. Except one or two, the TDS rate in a treaty situation may also be 10%. What was told was the reason in 13-14 budget was that the rate of royalty under the Income Tax Act is lower than the rate provided in number of DTAAs. So they believe there is an anomaly which must be corrected. Therefore, the rate was increased from 10% to 25%. That in the budget memorandum, which stated something like this, that in some cases, this anomaly, what anomaly? Domestic Act 10%,
treaty rates above 10% has resulted in a taxation at 10%, even if India as a country has a higher rate of tax under treaty. So one believed that one wants a larger pie of cake. So we want to go back and put it to 25%, so that the treaty would ultimately reduce the rigors of taxation in the way in which Section 90 subsection 2 typically envisaged. And therefore, in order to correct this anomaly, the rate was increased from 10 to 25% at that point. There was a reduction. So there was a change in policy when the when at that time the new government, the pre-existing government as well, came into power, and this was in many ways a full-fledged budget. Then late Arun Jaitley provided a lot of reasons to say that why I am reducing from 25% to 10%. It was stated that today I see a lot of young entrepreneurs running business ventures or wanting to start new ones. They need latest technology. Therefore, to facilitate technological inflow and for a small business at low cost, I am reducing a particular rate concern. Memorandum stated that it was to reduce hardship to small business entities. So I'm reducing the tax rate or the FTS royalty rate from 25% to 10%. This was the shocker which came when the bill was proposed, when the bill was passed. And it is not clear what is the intention to bring it back to 20%. Because it was done at the fag end of March, maybe the last week, there is no representation, because typically the bill amendments in the bill gets introduced at Lok Sabha. At that point, there was certain issues relating to certain reports of one large business industrial house to which price rock bottomed at BSC NSC. But nonetheless, because of the ruckus, there was no debate which was there in Lok Sabha, and this bill got ultimately passed into Act, and Act ultimately received the President accent. So the law as it stands today, the rate of royalty FTS is 20%. There is a significant dilemma, because then the questions which one would surely ask or which one would wait is that what has changed between that 15-16 to 23-24? Is it that small business no longer faces any hardship? Is it a question where one would not like to incentivize the Make in India story? This in many ways even contradicts what government did 2 years before by reducing the tax rate from peak 33% to 25%. To motivate new industrial manufacturing by bringing the lowest tax rate to 17%, making India highly competitive. Now, this conflicts with overall theory. One would believe that at appropriate time, some clarification would be coming. There is a result to this. There is no fallback option now. I am claiming treaty benefit at 10%. For whatever reason, that treaty benefit is no longer available. My backup option becomes 20%. Are we now making a statement that the backup option is so deep that it will be treated as if it's an anti-abuse provision, so that the 10% peak rate would be now 20%. We are not discussing the interest consequences, which will nonetheless increase the interest cost. What seems to be the legislative assumption, and one does not know which report supports this assumption, one would love to see as to how this assumption ultimately kicks in. What are the income streams which we are concerned? We are concerned with income stream in the nature of FTS. FTS by its nature involves some service element. FTS by its nature is not equivalent to royalty. In a conventional royalty, say for example brand, say for example trademark, to a large extent, not completely a know-how, a lot of R&D cost is incurred by the owner thereof. And therefore, what he expects is that the subsequent income will help him to first meet the original cost and thereafter yield the dividends of the risk which he has taken. Vis-a-vis that, there is an FTS. Now, FTS involves service element, FTS involves cost, FTS may involve technology, FTS may involve many other things concerned. But what we are seeing is that if 20% is the rate, and let's assume that I am doing a business in India, and I am a non-resident, I am not incurring cess and surcharge, otherwise the percentage will change largely. 40% is the tax rate concern. To achieve 20% taxability, assume 100 rupees is the income. The new provision says 20% under the Act is your tax liability. Forget the cess and surcharges of the world. Then the assumption is that the business is having 50% profitability. The assumption there is out of 100 rupees of sales, 50 rupees is your cost, balance 50 rupees is the distributable profit, from which I am taking 40% out of which. So this seems to be not exactly compatible with what one would see in a real time. Nonetheless, this is what it is. Why this is necessary is that there may be certain project concern. There may be certain particular instances where one will be forced to do a cost benefit analysis. If one shivers in terms of the treaty consequences, if litigations are large enough where I don't know ultimately whether I will succeed in treaty, then in that case, one will have to see whether it may be advisable yourself to admit that it is you have a permanent establishment in India. If your net profitability on a project at a direct basis is only 20%, then in that case, having tax at a gross rate is not something which will make a business sense. So some kind of cost to cost analysis may be required at the time of project feasibility, just to see what is my tax incidence of business. By no means we are criticizing any move of government. There was some thought which says that is it a precursor to STTR? One does not know, because there also whether it is permissible to have a rate of 20% is questionable. Nonetheless, the only point is whatever is the intention, it is always better that if those intentions are communicated, because this one does not know is an indication of some kind of policy measure which government is thinking on a long-term basis. What was told to us in last 2 to 3 years is that overall taxation would be reduced, FDIs in terms of investment would be encouraged, 17% is the corporate tax rate concern. To a people, because this amendment comes as a knee-jerk reaction. It comes at a fag end of a financial year, and therefore it is highly possible that the business and the contracts are ongoing. This is not an amendment which grandfathers your past agreement. No, even if there is an agreement which you signed 2 years, but your payment installments comes up in milestone. Let's take a case that I am creating a bigger refinery factory or some kind of an industrial factory, and my payment milestones are on a threshold basis. In that case, one will need to see how this amendments comes up. Pre-amendment, a business was told that highest would be 11% is the domestic tax rate concern. You ensure that 206AA protection is taken care of. But nonetheless, this was the highest tax rate concern. You did some kind of grossing up, 10.92 effectively, when you see on a comparative basis, on a case-to-case basis, if for whatever reason I lose my 10% and I'm asked to succumb to a 20% tax rate. Let's take an example that I entered into a business with you. The agreement stated that you would have those standard ticks. That means the recipient will give me TRC, will give me 10F, will ensure that it does not create permanent establishment. The liability is on a gross up tax basis. That means the payer is ultimately assuming that on a worst case 10% is the debit which I am going to take. Now, what if tomorrow in an assessment, the question comes up, is that true that you are beneficial owner of income? Tell me what did you do with the income? Then in that case, the backup option, the fallback option gives rise to a steep income tax liability. A broad comparison, and these numbers are only broad, but it may result in an incremental cost of 15%. This may tremendously change your entire project feasibility. It may entirely change your computations which you would have done. And hence, amendment at a last stage does not, or a last moment does not help anybody. Very clear DTAA prevails. Of course, it's an amendment under 115A. If 2013, the Chidambaram budget is taken any guide, then the intention was that there are some countries which are missing the tax bracket. And under the act, I am more lenient, more liberal to what I should have been otherwise. So these are some of the countries which will fill the pinch. Erstwhile, my TDS was 10% or 10.92%. Now my TDS would be 15%. Nonetheless, they are still taking benefit under the tax treaty. So the treaty will have its own elements of compliances and own elements of preventive measures, which one will have to take care and subsequently demonstrate. At least positive is that the capping will be at 15%. More positive is that let's take a case of India-Germany treaty. The TDS rate continues to be at 10% concern. I am not worsen off in a pre and a post era, just that I need to ensure that what was the position under the treaty, I continue to maintain those positions under the treaty concern. Net of tax agreements, go forward. Net of tax agreements will be extremely critical. Go forward, net of tax agreements would be extremely critical. because me as a payer should take care of a lot of things before I admit a tax liability. It may be better at times to increase the consideration by certain percentages and ensure that recipient under the bona fides of treaty bears the tax liability and does the compliance rather than me taking the tax liability on me. Nonetheless, the tax clause go forward in all the agreements which one enters should be vetted very, very carefully. Chaitanya, can you confirm on the voice and the slides are moving perfectly? Chaitanya? Yeah, Chaitanya. Okay. Anybody? All right. I proceed. Yeah. Okay. 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 It's fine now. All right. All right. I'm proceeding further. All right. Now DTAA prevails. Therefore, the benefit of DTAA continues. At an abstract level, at a broader level, we will deal with each of those cases subsequently. Take a case of India-USA treaty. Take a case of India-UK treaty. Take a case of India-Singapore treaty. There are make available clauses in the DTAA. So if I have got my certain standard documents in place, you are not worse off. Software. Now, Supreme Court laid down certain principles. If those principles are followed, that means those clauses in the end user license agreement are also there as part of your software licenses. And it is indeed a shrink wrap software which was before the court, then in that case, the treaty will continue to prevail. Services which are very, very incidental to installation, again, treaty will prevail. EPC contract dealing with onshore and offshore services, something which is not done outside India in terms of taking the purchase of goods or the delivery of goods is not at all impacted by technical FTS or royalty article. Nonetheless, the benefit still continues to some extent. Now, as we move forward, now we are on the treaty. So what we will do is first we will complete treaty. We'll deal with 10F. Then we will again come back to the 20% regime. What are the other implications? So that would be the sequence in which we will move. Few slides only on treaty, TRC. This is not a direct offshoot, but surely an incidental offshoot vis-a-vis my day-to-day positions. Erstwhile, my upper limit was 10.4, 10.92. Now, upper limit can be as high as 21.84. TRC. What was told was Section 90, subsection 4 was introduced in Finance Act 2012. What was told was that an assessee, not being a resident to whom agreement applies, shall not be entitled to claim any relief under the agreement unless he provides a certificate of him being a resident of that particular country. So that means all in all, what was told was give me a TRC. If you don't give me a TRC, you are not entitled to treaty benefit. Fair. What was then thereafter told in terms of memorandum was that there are instances where taxpayers who are not tax residents of a contracting country do claim benefits under DTAA. As it is necessary that DTAA, so therefore it was thought that at least give me a TRC which is obtained from that particular country. Memorandum says, rightly or wrongly, and we have an occasion to deal with it, that TRC is not a sufficient condition of availing benefits under the DTAA. So just give me TRC. It's not as if your claim of DTAA is foreclosed. There are other conditions which nonetheless one will have to satisfy. Moving further, what if TRC is not there? We do have some judicial precedents at this moment which will aid us. The first one came from Ahmedabad Tribunal in case of SCAPS industry. What they stated was that going by the plain reading of statute, now that was a case where a treaty benefit was claimed in case of a 201 proceedings. That means as a payer, I made a statement that I don't have treaty benefit, I don't have TRC, then even then I'm entitled to take the benefit of DTAA. What was alleged or what was argued by the tax authorities was that in that case as well, you should have TRC because Section 19 subsection 4 is mandatory. What court did was they went further into the reading of Section 90 as a whole. What was told was that going by the plain words of the statute, the provisions of the Act in a situation covered by the tax treaty cannot put the assessee to any greater burden than the burden placed by the relevant provisions of the applicable treaty. They then make a reference to section 19 entirely. They also make a reference that when it came to GAR, there was a specific carve out to make a statement that provisions of GAR shall apply even if there is a treaty in place. They say, the tribunal says, this is the only rider, that means GAR, to the superiority of tax treaty provisions vis-a-vis the provisions in the Act. And therefore, even if you don't have TRC, your treaty benefit cannot be taken out. This decision was subsequently followed by two further other decisions, which largely follows this decision, not giving any further great independent reason. Now, where are we here? TRC is mandatory. Nonetheless, in a defense, in a litigation, one would like to take certain positions. Again, if I don't have TRC, then in that case, question is that what other documents should I have? Because in other decisions, as also in SCAPs, taxpayer was able to give some documents to convince that fine, I don't have TRC, but I have something else which gives me an inclination that this is the resident of another country. Now, nonetheless, according to me, TRC has to be taken as a rule of thumb. One cannot go on to other documents because it is not legislated which document will have superiority over other. Now, let's look this from a Form 15 CACB point of view. Let's look from a day-to-day standpoint. Of course, to a recipient, if you are filing a return of income, of course, if your case gets picked up in an assessment, you as a recipient cannot come to say that, look, I don't have TRC, unless you prove it that I made an application and in my country TRC is not issued, or maybe in US in the times of COVID, the IRS was closed and was moved into the COVID duty. But nonetheless, you would have still have some documents to prove that you are a resident of USA. You would have filed your tax return. You would have filed your annual statement with the body akin to ROC or the registry as they popularly call. You would have proved that I have got addresses, my electricity bill, so on and so forth, my utilities bill, so on and so forth are in this name, which is in USA concern. 15 CACB. Now, this is something which one would be dealing on an on and off basis. And these are the common questions which typically one forces or one encounters on a day-to-day basis. TRC is not available with that. Most of the time, what we see is that the contracts are concluded by business guys. It is only at the time of honoring the invoice that treasury team is taken into confidence, that the tax team is thereafter taken into confidence. And the question is that, look, this is a one-time matter. He does not have TRC. What positions to be taken? Erstwhile regime subject to 206AA, because even in 206AA, the view still exists, which we will deal with subsequently, that it is still a treaty override. But nonetheless, TRC is not available, one-time invoice, not a group company. In that case, what do you do? According to me, one has to stop there. They say in 15 CACB as well that you need to put a tick, are you having a TRC offer 11? Are you having a TRC or not? So nonetheless, one has to go back to the 21.84 option and immediately deduct tax. What would be painful is that if 21.84 is a net of tax agreement, the liability in turn is borne by payer, then the pain increases on a very incremental basis. Second question comes up is that, look, these are my group companies. Every year we make remittances. For whatever reasons, TRC is not given. We are informed that they have made application. We ask them, give us a copy of application. If that copy is given, at least there is a prima facie evidence that on a year-on-year basis, these entities are obtaining TRC in India. And therefore, one may perhaps take a view that even if at that point TRC is not available, one should have, one can still give treaty benefit. Number two can be a case where no acknowledgement copy of application is also given, but they just make a statement that, look, I will give you TRC in some months from now. You sign it on a trust basis. This is the time where the firm policies will come into the picture. On a very pragmatic basis, if on a year-on-year, the tendency is that TRC is obtained, but there is a delay. Nonetheless, there is a TRC to put an evidence in place. There can be a case to give a treaty benefit concern, firm to firm, case by case view. Relevant here, TRC is not available. This is what we typically see in terms of payments, which happens in Jan, Feb, March, countries which follow calendar year. You can make an application in those countries only if certain other prerequisite conditions are satisfied. You have paid taxes, you have filed your return of income, so on and so forth. So practically, it is not possible, unlike some countries like Mauritius to have a TRC or Singapore to have a TRC on the next day. Now, here are the cases where these are the months which are in vacuum: Jan, Feb, March. Typically, you get TRC in April, May. What do you do in these cases? Again, similar, that if those are group companies, if vendors are routine in nature, every year those payment comes up, then in that case, perhaps still with some kind of risk, a view can be taken that treaty benefit may be given. Application is made for current year, take that application in picture, see if every year TRCs are given. If this is one-time vendor, then it may be very, very risky to give treaty benefit without having a correct documents in place. We come to know at times that country of residence does not issue TRC. Those are third world countries, not where frequently India would be dealing with. There are cases, Morocco and so many countries which does not issue TRC. In that case, what do we do? Then in that case, one would still need to believe that what is the reference of Article 4 in a DTAA or Article 1 in a DTAA. A benefit of treaty is given only if you are a person and you are a resident of a country. Who is a resident of that country is that person who is liable to tax by certain connecting factors. It may be domicile, it can be registration, it can be a poem if it's now an Indian context, so on and so forth. Then in that case, one still needs to do a further due diligence, try to get certain documents. Just a company registration, VAT registration, and many a times we see VAT registration, that may not be only correct document, because VAT registration, a non-resident having a P in that country can also get it. But some further due diligence is required before a treaty benefit is given. A lot of time, registration charges, etc., or consultants helping in terms of registration are not able to procure TRC. Many a times it is also equally feasible that my agreement or my contract is of $1,000, getting TRC requires $3,000. It becomes practically unfeasible. So here is a case where decisions like SCAPS industry comes into play. Many a time what one sees is that employees use their debit card freely and try to reimburse those, and then the company reimburses those people. Of course, from a company standpoint, once you make reimbursement, there is a candid admission that this liability is your liability. It sits in your P&L. Situation is no different than any other situation. One needs to ensure that the policies are brought into picture, which will ensure that company's risk is taken care of. TRC is not in English language, no problem. Try to convert it through Google Lens or whatever. If the language prima facie gives an indication that this is a tax residency certificate, one will have to proceed. There have been old history where at the time of introduction of this TRC requirement, the law stated give it in my format. Based on representation, they did away, acknowledging the fact that not all country will, in a dotted basis, adhere to what India says. So therefore, still if it is not in English, according to me, something which one can ensure. Again, TRCs are not available of relevant year. Now, at the time of year-end provisions, 31st March, a lot of issues are therefore faced that, look, I have tax residency certificate. Based on the estimate I'm making a provision and deducting TDS, I don't want to go into a litigation where why you did not deduct TDS on a year-end provision. In that case also, the issue will come up as to what is the relevant year TRC, this year or subsequent year. Nonetheless, if at the time of payment the valid documents are there, I don't see a difficulty in taking a view, because at the time of year-end provision, very seldom companies takes 15 CACB, only few would be taking. So it's largely a company call concern. Nonetheless, if you fail in any of the particular propositions which I stated, immediate fallback is 20% under the domestic law. Now there are some unique changes which we saw over the last 1 year. Some of the things which I thought it's always good to share, because amendment is a proposition. Amendment only says that now 10 becomes 20. But what are the other things in the roads which one will encounter? And one needs to ensure that we really hurdle it well. Otherwise, I will be caught between the thorns. India-UAE treaty, classical case. This treaty was amended. Most of us are aware of the legislative history. Nonetheless, the treaty at this moment says that who is a resident of UAE. The person who is resident of UAE, say for example individual, as per Article 4 of the treaty, he is an individual who is present in UAE for a period or periods totaling to 183 days in a calendar year. Two things to note: in a calendar year and a physical presence of 183 days at least. If you are present 180 days, you are not a resident of UAE as per India treaty. UAE DTAA. There is another thing, another clause for company, that a company which is incorporated in UAE and which is managed and controlled wholly in UAE. Incorporated in UAE, managed and controlled wholly in UAE, 100%. Anything less than 100% is not wholly. So this is what it is. India UAE DTAA is unique. They does not have FTS clause. Any payment which India makes to a UAE resident does not suffer TDS in India, provided you have TRC 10F and certain standard declarations in place. Now, there is certain things which one needs to be mindful. This proposition or law, most of you are aware. There are certain developments which have taken place. UAE came up with a new residence rule. There is a cabinet resolution. I've given link subsequently. It is here somewhere in the bottom side. You can click and read it on your own. UAE came up with certain resolution. What is this resolution? It's akin to what is an income tax rules in India. That if certain things are done, then you will get a TRC. What was the old law? What was the new law? Resident test for legal persons. Resident test for legal persons. The old law says it is incorporated at least for 1 year with documentary evidence. So if you don't give an evidence of incorporation for a period exceeding 1 year, I don't get TRC. If you give an evidence, I don't look anything else, but then give you. What does the new law say? Company which is only incorporated or formed under the UAE laws, excluding foreign branch, is fair. Or it is tax resident as per applicable tax laws. So whatever is the new UAE corporate tax law, it is resident. What does the treaty say? Treaty says it is a company which is wholly incorporated in UAE, which is incorporated in UAE and which is managed and controlled wholly in UAE. Vis-a-vis that, the local law is different. So there may be cases where one would be showing the TRC. The TRCs would be furnished. The question for us would be that which side of the table should I look at it? Should I doubt everything which comes to me? We'll deal with it in some time. For individuals, earlier law says he is resident of UAE for at least 180 days and you give me documentary evidence. Some experienced professionals of UAE, good friend and well-wishers of mine, made a statement that even if you cross 120 days, it is practically possible to get a TRC in old regime. Now you've got a new cabinet resolution which makes all the criteria, all are alternative in nature. You satisfy one, get the TRC. Usual or primary place of residence and central of financial and personal interest are in UAE. So you may be traveling all across the world, but your family is in UAE. You are traveling for business. You have a home in UAE. You may be owning a villa in whatever best of the places. You get a residential CTRC. His physical presence in UAE is at least for 183 days in 12 months. A welcome if TRC is issued under this. Your physical presence in UAE is for at least 90 days within 12-month period, and you have got a UAE citizen, UAE residence permit. You're a GCC national through either as a permanent residence or a job. That means or a job or a business in UAE. So the threshold to issue TRC is reduced significantly. Vis-a-vis that, what is there in the treaty? Your presence in UAE should be 183 days. What is real is not real, and what is real is not known. This is the place where the UAE as a treaty comes from. What should be done is, it's largely going to be a difficult situation here. If the contract says high in value, sufficient due diligence should have been done. Sufficient work should have been done. The practice which typically one follows, take a case of India-Singapore treaty. There is a protocol, erstwhile protocol, now part of the treaty, is that you incur certain expenditure. Your main purpose is not to take tax benefits, so on and so forth. The practice followed was that the client, the other party, was asked to get a consultant opinion, which would validate and certify all these things, and then the payments was made. Now, if the payment is large, one-off in nature, large would mean large in number, not to the payer. For payer, anything can be larger, anything can be a lower amount. Then in that case, one should exercise due diligence. In other cases, if it is individual and one needs to be very careful, one should obtain evidence of physical stay. If it is UAE, then perhaps if it is company, one should just look at some of the ancillary factors, their website, so on and so forth. Try to see the minimum due diligence you can. But most importantly, get a declaration, get a certificate, get something in writing, because there will, at some point, the Indian judiciary or the tax law in particular will have to go on the law of bona fides. We'll deal with the PPT test. We'll deal with some kind of other anti-abuse provision, where except for a declaration, there is nothing more which is there. The first signs of acceptance of declaration came in the second circular under section 194R, where they made a statement. The case was that, oh, there is a hospital, there is a doctor, on whom should the pharma company deduct TDS? They made a statement that you get a declaration from either of the party that you deduct on him, that is a compliance of law. That means the declaration itself is slowly trying to have a legislative acceptance. If something is done on a bona fide basis, I don't think the payer who is not aware of what goes into the house of the recipient should be take text in a penal basis. Nonetheless, one needs to be careful. Article 5, and this is how the TRCs would be issued. That's Article 5 of that resolution, the cabinet resolution, which is there. A person who considers himself that he is resident should make an application. If authority is satisfied, TRC would be issued. Nonetheless, they make a statement that if DTAA sets out certain conditions for determining of tax residency, the provisions of that DTAA on determining the tax residency shall apply. Minister shall issue guidance. But nonetheless, what I try to find out from the ground, and surely members may share their better experience for the betterment of all, that both TRC, whether issued under Article 5 or Article 6, may look alike. But if some of the TRC and countries like Qatar, etc., do mention the state that you are resident for India UAE DTAA, that may surely have a higher credence first. There are many pitfalls on the road. And one does not know that if an honest taxpayer, even if he takes best of the care and caution, he may still find himself falling into a pitfall, something which was covered up, something which was not visible. But nonetheless, the consequences are going forward going to be very dreadful. We are aware of the PPT test pursuant to the BPS initiative, now forming part of most of the DTAAs which India has entered. What does that test say is that notwithstanding anything contrary in provision, a benefit under agreement shall not be granted in respect of an item if it is reasonable to conclude, having regards of all the facts and circumstances, that obtaining benefit was one of the principal purpose of the arrangement of transaction. Many a times, as a payer, how do I come to know? Large value transaction, lot of due diligence one would do as a payer. For small value transaction, one does not know. What is difficulty is, let's take an example of India UAE treaty, India Thailand treaty, India Indonesia treaty. A lot of treaties which does not have FTS clause. I'm just taking because the topic is FTS and royalty at this moment. Then in that case, I am granting a treaty benefit. How will I come to know? It's difficult because a lot of them have offices across the globe. Some countries may not have a favorable treaty with India. One needs to know if on the certain additional evidences, look at the email concern. If the signature refers to the address, which is say not from those Thailand, UAE, etc., then in that case, there is some evidence that this is routing. There are cases of law firms which operates from various geographies. So the billing is done by one particular entity, for example, UAE. It may be others as well. But the partner is rendering services from the third country because they say that this is a specialist partner. This is the guy who, say, for example, has an expertise in IPR, has an expertise in a particular patent matter. Then I'm making certain technical services. I'm making payment to that country. It's that much difficult. Also, we do have certain other things like, for example, the entity which is entitled to treaty. Pass-through entities are one form. There are other entities where by its own legal nature, the income just moves to somebody else. A US limited liability partnership. We are aware of link letter and certain decisions concerned that overall treaty benefit should be given. India-UK treaty made certain amendments in the treaty itself, which made a statement that as long as income is taxed in the hands of beneficiary or the resident, income should be taxed, treaty benefit should be given. One does not know what happens to a particular LLP which has beneficiary, which are across the globe. Somebody in USA, somebody in Germany, somebody in France. Then in that case, I'm giving a treaty benefit. I don't know how that vacuum of law will ultimately be filled in. Those are certain areas where one needs to be very careful. Erstwhile, the position which many people used to take was, there is a dilemma. Let's play conservative. Let's gross it up. Or let's bear that 10 point whatever additional person liability was there. In that case, now the delta becomes large. It is 20%. Provisions of PPT, one does not know how it would be implemented. Having said that, still some of the assessment would have started. One will need to see the turf as to how this provision are ultimately picked up by revenue. My experience was this provisions was invoked in some cases, but again the arguments was so haywire that I don't think in those cases which came with where I had a personal occasion to deal with will ultimately get succeeded. It was largely papers picked up from various materials and a 40-50 pager case made. Nonetheless, this has to be taken carefully. There are many other SARs which are there as forming part of treaty. These are very, very specific provisions. India-Singapore Treaty. India-Singapore Treaty is favorable in more than one case. Make available is in the treaty AA. The royalty rates are also largely okay. Most importantly is that for transfer of technical plan and design, SNC leveling Delhi High Court also took a view that for that also requirement of make available should be satisfied because the treaty contains this kind of that the payment consists of development and transfer of technical plan or technical design, but excludes any services that does not enable the person acquiring the service to apply the technology contained therein. Now, one needs to see very, very carefully is that even if somebody is claiming treaty AA benefit and payer is also equally claiming because he is the exemption in a net of credit contract means that even a payer has got advantage. Then in that case, one needs to be careful that I am not hit by treaty particular SARs. The study that much has to be involved. It has to be that much done in a detailed manner. Why? Article 24 says that if where the agreement provides that income from sources in a contracting state shall be exempt from tax or taxed at a reduced rate in a contracting state under the laws in force of the other state, the said income subject to tax by reference to the amount thereof which is remitted or received in the other contracting state, then the exemption is to be allowed only to the extent of income which is remitted. What does this mean? Singapore follows a territorial based taxation. If you bring the income in Singapore, we will tax that income. They are making a statement is that if the income is ultimately credited, say, to a USA bank account, but not brought, the first receipt is not done in Singapore, then you are not entitled to India-Singapore DTAA. So therefore, the bank and the place of payment also has to be factored in when one is making the treaty claim. The fallback or the backup option is now very, very costly. There are certain further pitfalls in the journey. The new version, synthesized text. Just take a minute break. Just 1 minute break. Yes, yes. The synthesized text. What was there was a comprehensive DTAA. Typically under the income tax website is where one would take recourse as a default option. Then came MLI, countries notified their own positions, MLI was adopted. So what was agreed was that the existing treaty would be overlapped by certain agreements or by certain notifications which two countries have agreed. It is like a marriage. If both of us agree, then to that extent, the entire clause will get replaced. And then there is entire complicated mechanism which is there. India-Belgium DTAA, at the time of signing, they prescribed a 20% rate. It's on the screen that if the rates of royalty and FTS would be 20% of gross amount. Subsequently, and please note that Belgium had a protocol with an MFN clause. So therefore, if subsequently you bargain a better case with another OECD country, then in that case, that particular thing would be incorporated into treaty. The plain language of the DTAA is that MFN is automatic. Nonetheless, government came up with a notification which made a statement that Sweden ultimately DTAA with Sweden has a better rate of 10%. So because of MFN clause, the DTAA with India-Belgium treaty gets amended and 10% rate is the default DTAA rate. What we see is that in the synthesized text, now ideally my comprehensive agreement before MLI, before synthesized text also used to read 10% as the rate. This is an exact extract from the income tax website. Now post synthesized text, the website again shows that it is 20% of gross amount. I am again aware that there are certain MFN clauses. So if you invoke make available, it can go to 0. But the larger point at this moment is that the existing synthesized text read with notification is misguided. Of course, synthesized text has a disclaimer in place that you should read the things independently. Don't come to us if something is wrong here. Fine. As a government, to what extent one can have a text on the website which can misguide is a subsequent question. We are not dealing with it. But as a professional, our role has to be that much intrigued with, and this would be known especially by the people who make regular payment to certain countries, that what has changed post MLI. Why? Earlier it was 10%. People took a view, let's deduct at 10.4, 10.92. We don't file return of income in India. Let's not even get into a tricky situation, because then I would be questioned too many. I'm taking 10%, 10.92 as default rate. I'm getting credit of 10.92 in my home country. I don't care. Let me not get into the clutches of an assessment and try to come into any kind of position. Now, for those people, now that 10.94 as a default option is gone. Either you go to 10% or you adopt certain make available arguments and make a claim of 0%. To them, 20% is still not correct. India-Belgium treaty still continues to be at 10%. In facts of the case, they may take 10% as the rate concern. But what I'm trying to only say is that this kind of challenges may come. I could locate few, but nonetheless, a detailed study can help many to locate many other things. Further, shrink wrap software versus software as service. What we are told is that there is a Supreme Court decision in case of engineering analytics. This decision, and this is an aftermath or post ESE world, as we may popularly say, is that there is a say that payment for softwares are no longer taxable in India. Get that TRC, get that TNF, get that notification, and that's the end. Get that standard declaration, and that's the end of the topic. But what is also critical is that one will have to see what is the subject matter, what was the subject matter before Supreme Court, what is the subject matter or the case which you are dealing with in your client's case. This comes up very regularly for those people who are dealing with CSEB. Extreme care and caution is to be exercised here, because the line of distinction is very thin. What was there before Supreme Court was host many countries, USA, Singapore, a host of popular TTAAs with which India would be importing softwares in whatever capacity, be it as distributor, be it as owner of the software concerned. What was told was that there is an end user license agreement and there are certain restrictive clauses. If these restrictive clauses are forming part of your end user agreement, perhaps one may make a statement that Supreme Court decision applies to me in all respect. What was told by court is, and I am reading one paragraph because it is important. A reading of aforesaid distribution agreement, and there were three cases. It was just not distributors, so there were three other kind of classifications which was there. That a reading of aforesaid distribution agreement would show that what is granted to the distributor is only a non-exclusive, non-transferable license to resell computer software. It being expressly stipulated that no copyright in the computer program is transferred either to the distributor or to the end user. This is further amplified by stating that apart from a right to use the computer program by the end user himself, there is no further right to sub-license or transfer, nor is there any right to reverse engineer, modify, reproduce in any manner. In other words, what Supreme Court state was that the proprietary right continued to remain with the original owner. What was given by the end user was a limited right to use the software. This right to use is not the right to use envisaged under the DTAA, and therefore the payments does not amount to royalty concern. Now, that case before Supreme Court, some of the paragraph would indicate it was a case of floppy disk, it was a case of CD, and that was the world which was there before this cloud computing or software as service came into the picture. Now today, even software as services operates on a license basis. Let's take one or two cases concerned that I have got a German company which provides certain MIS and data and data pooling kind of services. So they do data mining, they do give certain MIS services. In fact, the softwares are so capable that you don't need to take any decisions, is what the company claims. Let's take a case that software is integrated with my accounting SAP, which is there. I get certain reports. It can be what is the employee-based profitability, something which Zoho Books does for at a smaller level, and SAP does at a very larger level. They can also give you features like there is a smaller change in raw material, say by 10%. What if I increase my price by 2%? What would be my profitability? If I am substituting raw material A with raw material B, then what is the big picture looking like? What if I reduce my consultant cost by 50%? What is the impact of profitability? What if so on and so forth happens? They may also integrate certain compete prices. They may integrate commodity prices into the system and give you an indication that prices are on rise. You have got a huge amount of inventory with you. Therefore, it is possible for you that you may put higher than what you are currently putting, so on and so on. It's a license. It's a license. Something which is given at an enterprise level. Let's take that I took a plan of 50 user license. So 50 people can log in. They will have a user ID. They will have a password with you. The question for us is that German company has made a statement that take my TRC 10F declarations and don't withhold tax. They may also produce some opinions to you that I am covered by engineering analysis. They may also give you a declaration that I am paying tax under equalization levy at 2%. Therefore, I am covered by equalization levy. Don't go into this kind of thing at all. And end user license agreement will again have all the clauses which were there on the screen. The question for us is to look into the facts of the case. This is no mean a shrink wrap software. This is clearly a case where certain services are performed by software. There was an old to some extent, but a Bharati Airtel decision which made a statement that no, there is a human element. There are certain human element. The human element has to be there. Subsequent Supreme Court decision in case of Kotak did away with the human element. So they made a statement that services can be rendered by robots. We will have ChatGPT also in the picture if somebody subscribes at an enterprise level. We don't know for this kind of cases, will you say it's a shrink wrap software or it is something which is nothing but services? A shrink wrap software in many ways is something which is there, say for example, MS Excel, say for example, Word, say for example, Adobe PDF. So those are the cases where the product is largely standard. It is given by the developer. There may be some last mile of configuration that I want to insert my font. I want to have certain kind of restrictions on usage. I want to have that comment should also have, say, Bhaumik, my own organization, so on and so forth. But this does not change the substratum. It is still a standard software which is given. But if the output changes depending upon the input of data and the machine is more intelligent, then it is possible that this may amount to service. I took a case of German company because there are no make available. If it is US, then surely it is necessary that make available clause can be imported. Services may not be taxable. But if you are going to USA, there is another clause like limitation of benefits. That if the company does not have a qualifying shareholder, which are residents of USA, then that company under treaty itself was not entitled to treaty. So this is how the law is developing. One decision, how do I apply in a different situation, is where the ESC decision stands at this moment. Further, there are cases where judiciary is not settled. We were told, let's take a case of royalty payment. Let's take a case of a technical services, which says that Article 12, the slides, one page was missing. I will incorporate it later and maybe we will settle it. Let's take an Article 12 in a typical situation, which says that royalty or fees for technical services paid by a resident of a contracting state to a resident of another contracting state. The question was, what is the meaning of this word paid? There were 3-4 decisions, including Siemens in case of a Bombay High Court, and perhaps a unanimous decisions which made a statement that paid would mean that only when the money is received by the recipient, it is at that point that the taxing event comes up. It is irrelevant that the Indian company credits this account because services are already rendered. Now, what we will have is this kind of mismatch. Why? The entire decision or certain tribunal, that is the Mumbai tribunal in one of the decisions, have referred this matter to a special bench. It was in context of interest, but I think the proposition will apply in all the cases concerned. The case of reference was that, oh, there is certain section 43(2) under the Income Tax Act, which says that paid would mean paid or payable in accordance with the method of accounting which is employed. Nonetheless, here the question would be that what will be the final outcome, one does not know. If I am taking a view, as a payer, And that's where one will need to reconcile and take perhaps a conservative position, because litigation on this point or the outcome is not certain. That if I'm taking a view that, look, I am deducting TDS at the time of payment for whatever reasons, then in that cases, if tomorrow court take a view that no, if at the time of credit this should have been done, then in that case, because what happens is, take a case of year-end provisions, I don't deduct TDS. I am put under a 201 proceedings. I make a statement that, look, 195 does not override DTW. 195 explanation says that the point of TDS is payment or credit, whichever is earlier, fine. But the TDS has to be reconciled or has to be matched with what is the ultimate liability in the hands of recipient. And because the year of payment is subsequent, these are just a management estimate. Whenever I make the payment, the provisions are reversed in subsequent years. So I don't deduct TDS. This additional argument, if tomorrow court takes a view that no, it was the paid would mean payable and it ultimately goes on an accrual basis, both the parties likely to come in for an issue. There are no set of provisions under that you deducted TDS at 10% in year 2, take a set off in year 1. In year 1, because nothing was done, 20% would be the tax liability under the revised provision concerned. Year 2, what will happen of 10%? One will need to apply certain principles under Article 365 and make a statement that, look, government can't enrich, government can't take a money beyond what was due. If you took it at 20%, give me refund at 10%. If it is possible to amend the TDS return, best is to amend the TDS return rather than get into a litigation per se. Other examples, classical cases, trainings. What do we have? China is written, typically it's a USA, and USA would have number of Harvards and Oxfords and Wharton's universities of the world, which provide this executive leadership program, 20 days, 30 days, 40 days, 60 days, case. This is not a day seminar which a chambers would hold. These are intense training. This is not a 4 days RRC chambers will hold where participants will enrich themselves and go back home. The question which always comes up is that what position has to be taken here? Is this that it amounts to make available? Is it that nothing should be deducted, or where in which part of the world we are? Before that, a typical difficulty which comes up is that this universities does not give you any documents. They don't give you TRs. They don't give you 10F. And there is a pressure coming from a very, very senior person in your organization that, look, I am missing the course. Almost the subscription is full. Because of you, the flight costs have now increased. And it is equally possible for whatever reasons that he would have missed this seminar thanks to this debate of TRC. What do you do? Then in that case, if TRC is not there, it becomes that much difficult to invoke makeover. But perhaps at this stage, decisions like Scaps Industries and the others which followed can be a case of some use. Each of these university has to mandatorily publish their annual accounts. These annual accounts are easily available. Unlike India, you don't even need to pay 25 rupees. You can download it easily. Annual accounts has all those 501k or whatever exemptions are there. Everything is stated. They make it very clear that we are in USA, so on and so forth. Have this kind of ancillary documents, and then you make available benefit of make available, because that may be useful on a case-by-case basis. Of course, much would depend upon an entity risk appetite. Many a times the training budget gets shrinked because erstwhile in earlier time it was 11% which had to be grossed up. Now it is 21.81%, 84% which would be grossed up. On a lighter wing, one does not know that because of this training, the L&D budget gets wiped off, and somebody proposing to enroll for some program of let's illustratively chambers will miss it because the budgets are now exhausted on a very lighter wing. Nonetheless, let's take a case as to what are the ultimate outcomes. It is very, very fact sensitive. If somebody is told that, look, I will teach you a leadership program, much will have to go into the details of the program. If I was not aware, or the program tells me that, look, after this 21 days, there is an intense training, then in that case, you would be unable to practice independently on this area. Who knows, make available may be satisfied. Let's take a very hypothetical example. Kiritbhai comes here and makes a statement that once you enroll for FEMA program of chambers or maybe any other associations, in that case, after this 21 days, you can practice FEMA on your own. There is some kind of imparting which is done. Make available does not require that both becomes equal. So when a Drona and an Arjun, that's the famous example, right? When an archery was particularly taught, it much depends upon the students and his ability to take that particular skills into him. The law does not require that both should be equal. Of course, there has to be a tacit understanding that the person who is earning or the person who is learning is somebody whom I am aware that I am teaching. Certain vague learning is not something which fulfills makeup. At the same time, if it is a largely a networking event, some few days event where you are meeting certain business, like-minded business associates, those are networking events. You will meet certain other professionals. You will meet a larger pool whom you believe from a business standpoint would be beneficial. That programs does not satisfy the requirement of make available. Very, very factual case. No generic conclusions are possible. Wrong conclusion. The default option is very, very high. LinkedIn. Number of programs they run: recruitment service, learning service, sales solution, marketing services. In that case, the question comes up is that what is the nature of payment? Do they satisfy make available requirement? Do they go into an equalization levy? Fortunately, one part of equalization levy, or the 2016, which we popularly call, there's only 6%. There is no amendment there. Maybe sometime, someday, that 6% will slowly become 10% and then 20%. One does not know. Today it is pegged at 6%. Now there the dilemma is that should I deduct tax at 10%? Now a lot of contracts have been agreed where LinkedIn is bearing the tax liability. So deductors would then therefore feel, let me deduct tax at 10%. If the payment is made to Singapore, TRC, 10F, etc., given well in deduct tax at 10%, higher reserve is 6%. Some contracts are such where liability is borne by the payers. There the dilemma is whether it is 6% or make available conditions get satisfied. Classical case is that of a recruiter. On a plain reading, make available condition does not get satisfied. Every time when I need recruitment service, I need to go to LinkedIn, pay certain money and get certain services. But one needs to see very, very, very clearly as to what is the conduct. Typically, they also give certain career page. They also give certain openings. They also give assistance in terms of building brand. Because the product is like this, that we will ensure that you get a page which gets a lot of visibility. So next time when Diwali is celebrated, you put it in a particular page. Perhaps a person who likes a better work-life culture would like to go and enroll in your organization. But here there is a tacit marketing which is taking place. There is an online advertisement which is taking place. Contract at times does not bifurcate between A and B. There are certain marketing solutions. This is all online. Let's take a case that I'm a chartered accountant and I want to know who are foreign nationals who are today located or in India. Because I would believe that these are the companies which are so-called a potential pitches. I may pay LinkedIn certain services, put certain keywords, and I can get a list of all those companies which are in India. And these are the contact details of those people, and then I can keep on pushing my messages. It's an online marketing. 6% is the TDS applicable. Nonetheless, we need to see very carefully. If it's 6%, new amendment does not apply. If it is 10%, no problem. If it is 0%, then one needs to really see which way of the side one will need to see. It is equally possible that in the proceeding, I may well admit that no, don't tax me at 20%. There was an error in judgment. Certain training, because LinkedIn also does a lot of online training. They ensure that the participant needs are taken care of. So it's like this, that I took a particular training in MS Excel. I understood MS Excel for 2 to 3 hours because they believe this is something which you should know. Then certain questions are posed to me. After questions, the conclusion is that this guy, same dump which he was, perhaps in 3 hours he was more on Facebook rather than that. I would be asked again to enroll for the training, and my HR guys would be given the report that there is no performance improvement. I attend it very carefully, and then I scored 80%. I attend it further carefully. My certain needs was taken care of. That perhaps the difficulty is in formula. He is using mouse more than what is required. Further training would be given to me so that after the end of the process, my technical capabilities would be to what organizational needs make available possible. Nonetheless, I am only putting proposition. Not all training satisfies make available, especially conference and seminar in my view does not satisfy the requirement of make available. We would love if that conference is satisfied, because hearing some of the seniors, one would have loved if make available principle works. Every knowledge which they have gets imbibed in us, but practical life goes in a very different way. It is only their hard works and passion for subject which pays, and we are yet to reach, at least I am yet to reach there. Nonetheless, coming further, intra-group services. Again, what do we see? There are certain common procurement companies. They are located in Singapore, they are located in whichever Netherlands, they are located in whichever part of the world, USA. What is the role of this entity is that they bargain for the entire entity. Microsoft Teams. If I go and enroll for a particular subscription, X rupees is the price because I've got 50 employee company, I've got 100 employee company, I may have 1000 employee company. But at a global level, I've got 1 lakh employees. I've got 1 lakh users. So there is a global marketing team which would bargain it very well. Various other firewalls, certain subscriptions, so on and so forth, depending upon my business, would be procured by them. And ultimately, I would be paying to the centralized company. This centralized company in turn would be paying to a certain users. Cost allocations are given based on certain drivers, certain things which assume meets transfer pricing requirement. TP, we will deal with it maybe in 10 to 15 minutes. We have the central procurement agencies which are there. Now, these central procurement agencies typically purchase licenses from various, and then there is a distribution. The question comes up is that when I'm making payment to them, what is the withholding rate applicable? Lot of arguments. It is something which satisfies make available requirement if it is US, Netherlands, UK companies, so on and so forth. Some of them, if they are not from a favorable treaty jurisdiction, they take a view that look, to the extent of software, it's a pass-through. The entity in the transfer pricing policy does not add any margin at all. $100, $100. Certain markup was added, but there in the markup also, that cost of software was not factored. It was only some token employee cost, leasing of property, that means the rentals, etc. So the markup itself would mean that, look, I am not taking anything for this software. I apply a AP Moller or some other Supreme Court decision and come to this particular conclusion, no withholding. The questions are there that what if this entity is just an aggregator? What if this entity is merely passing on costs? So I'm buying from Microsoft, I'm buying from Adobe, I'm buying from LinkedIn, certain global training materials, so on and so forth. Then the question is that is the TRC of this company itself okay? Because reimbursement works on a different principle. Of course, that argument we have seen in some of the reported case laws have been accepted, but necessary to create additional defenses. The question there is that then therefore, should I then need that the only TRC, 10F, etc. of the intermediary entity is good enough, or I should take from all the software companies, which is practically as good as impossible? Those are very, very difficult questions. One will need to see. Principally, if USA company is nothing but a service provider, he may be a low value service provider. Even then, the privity of contract is vis-a-vis US company. It may still not amount to royalty because USA company itself does not have any right of proprietary. The agreement, the master agreement itself says that you can only circulate within the group companies, perhaps referred to in annexure or the schedule. So that itself means that vis-a-vis me and the USA company, there is no agreement, there is no royalty which comes based on the Supreme Court decisions. Vis-a-vis me and the third party, I don't have privity of contract. I am only making payment to USA. Without prejudice, if I am able to have certain documentary evidence, a CPA report or an auditor report, which says that nothing other than cost was given on a back-to-back basis, then in that case, there is additional defenses which comes up. Question will also be on beneficial owner. If this guy is only a pure aggregator, where the role of this guy is nothing but to enter into a bargain and let each of the entity individually deal with it. I am only collecting the money because the vendor there, the third party there, does not want to deal with 100 subsidiaries. They does not want to deal with 100 countries' laws, be it on VAT, be it on income tax, so on and so forth. Then in that case, the question would be whether you are still a beneficial owner of income. This is a very, very detailed topic. Somewhere next time, next day. Cost contribution arrangement for services. Here are the cases where I am making payment to a particular company, where one needs to read the CCA agreement very, very carefully. Am I getting certain rights out of it, or it's just the services which they are enabling? If it is that I am getting rights, where certain ownership rights, and those were the ABB decisions of the AR, and of course there is one more negative decisions which is there, but all of them are very, very factual. If I am making a payment to co-own a particular IP, then I will not withhold tax because this is nothing but a capital contribution which I am going to make. But if the conclusion was incorrect, because perhaps my right was very, very limited to maybe say use without making payment of any further royalty, but I will not have any economic interest when their IP is particularly sold. a view may be possible that this was nothing but an advance payment of royalty, which otherwise a know-how usage you would have paid. It is okay that if it would have been a year on year, if there was certain risk element involved, that what if after making payment this know-how does not reach the market or does not meet the appropriate benchmark. That is a separate commercial distinction. I need to be very, very careful when this kind of positions are taken, because it takes 5 to 10 years to reach an ultimate conclusion here. Reimbursement. This is something which again is very, very factual, entity to entity. More of the internal guidelines which the Indian company issues vis-a-vis a large MNC, that is what is ultimately going to come. We do see certain kind of payments, traveling, lodging and boarding, training cost, conferences cost, because I would have, let's take I am an MNC. For the people who are promoted at a particular level, they take them to a particular country. Appropriate cost is incurred by a central entity, then they are recharged to me. In that case, the question is, what would be the driver? Can I take an argument this is a plain reimbursement merely because there was no margin? Possible if it is training, travel cost, if it is something where I do a common exhibition. Let's take an I am a brand, say for example, XYZ car brand. I'm doing a global function. I'm launching a new product, a new model. All the countries thereafter are given particular allocation. Perhaps some famous Hollywood and Bollywood celebrities were invited. So all those things was given. There was a portion back to the country region. That case, depending upon the documents, one will need to see whether you satisfy markup or not. Now comes is the difficult part is third-party consultant cost. I have expatriates in India. I appoint a global MNC firm, six some big four. The big four charges the central pool. Each of the big four charges central. Why? Because both of them, say at a UK and a UK level, entered into a contract, where a UK enters into a contract with a particular entity, making a statement that I will use my global network. You don't worry. Between us, these are the standard hourly rates. So therefore, I have to reimburse vis-a-vis what cost I have incurred. The question there is, that in that case, what do you do? Should I treat it as pure reimbursement? The question is that what is then the principle of reimbursement? Reimbursement will mean that it is not my liability. It was my some aids which incurred liability on my behalf, which I need to reimburse. Therefore, the privity of contract was therefore with that MNC or a particular consultant. Then I need to ensure that I should then have the TRC 10F of those consultants if I am taking certain favorable groups. Need to distinguish. Let's take a group allocation. I am getting management service, HR service, marketing service, so on and so forth. There is a cost driver. There is a statement certified by a CPA, no markup is involved. Does this mean that this is reimbursement or a service without markup? Forget the transfer pricing provision. Perhaps that entity would have taken certain ruling. India, I am not paying markup. Indian TP authorities are not concerned. In that case, one will need to distinguish what is it that I am doing. If it is reimbursement, the criticality is that then identify to whom the money was given, ensure that there are backup documents. What we see is that on face of it, travel, training cost, exhibition rentals, some such kind of reimbursement which are typically thrown to India, but there are no backup documents. There is a simple debit note, some Excel sheets which would write your name and X euros or dollars which are payable. In India, on a TP standpoint, it will sail on reimbursement, because there it's based on some different principle, whether you render service or not. This is enough to show you did not render service. To India, I need to prove that whether penny by penny amount is matching, so on and so forth. If I fall based on an incorrect documentation, the delta is big vis-a-vis the earlier world concern. Digitalization of 10F, again a barrier to treating. What was the practice? Pre-16 July 2022. Look, what was digitalization always helps, but digitalization should be in a manner that it does not create difficulty to anybody. A forced digitalization always will fail. Maybe government will, I'm sure, come up with some kind of an amorphous portal where PAN number would not be required to take a Form 10F. You just upload certain things, you just get a unique number, and that's enough which can be quoted for the purpose. And even the payers who are making payment in their TDS return, they can put this unique number, because you know whom this unique number belongs principally. Having a PAN itself creates a difficulty. Section 90, subsection 4, what does it say is that TRC is required. Section 90, subsection 5 says is that in addition to above, certain documents which would be prescribed, and there is a rule 21AB which prescribed would also be required. Earlier, it was a simple form which was notified. People either used to fill in hands or it was largely manual, digitally signed, non-digitally signed. They used to give the form, and this was not taken as evil as long as all the information. What is told is that section 90 subsection 5, we used to file the forms manually. Just out of the word, a notification comes up and says that this form has to be filed in an electronic manner, verified in a prescribed manner. The process which was there was that you need to go to your income tax portal. The portal requires permanent account number. Many non-residents who avail treaty benefits will not have permanent account number. They may be one-time vendor, or they may be of the view that irrespective of the consequence, we don't want any registration in India. Because if your PAN number continues to be dormant, one does see on and off certain queries coming up. What if some other person just writes a wrong PAN and in your 26 year, wrongly an income is stated, you will be called for reopening. So there are genuine reasons why a person does not obtain PAN in India. And therefore, it was thought that what happens is the Form 10F requirement. Two notifications came up. And of course, every relaxation is given with condition. What was the condition here? NR not having PAN in India and who is not required to obtain PAN in India is exempt from 10F up till 31st March. Same requirement is extended up till 30th September. There is a small typo here. It's extended up till 30th September. What happens after 30th September? We will tell you on 29th September if you are lucky, or otherwise 30th September. Therefore, what is the position at this moment is that up till 30th September, you have manual Form 10F. You are a non-resident who does not have PAN or who is not required to obtain PAN. In that case, take the manual 10F and proceed further. If you are a non-resident, for whatever reasons you have PAN in India, let's take for 5 years before you had a permanent establishment in India and you obtained PAN. That PAN is not cancelled and still lying in record. You need to obtain a digital 10F. It is possible that your 5 years old employees would have resigned. Their email ID and phone numbers would be in portal. You try everything to revise your password, but you can't revise. But nonetheless, legally, you need to obtain a digital Form 10F in India, digital Form 10F. The impact area is that what if I don't have 10F? Let's take that I'm going in 30th September, or I am required to obtain PAN in India, being an NR, but for whatever reason, I don't obtain PAN in India. There are cases where there are make available clause in DTAA. I am taking benefit relying upon EAC decision of Supreme Court, shrink web softwares. There are import of goods, significant economic presence. They say that if somebody does any transaction above a 2 crore threshold or 1 crore threshold, as the case may be, with a non-resident, they have some kind of business connection in India. Therefore, you are taxable under the Act, but that does not override the treaty. To get treaty, I need Form 10F, SEP provisions in India. What if I don't get 10F in a digital form? But obvious that guy is not required. There is a simple import of materials which I have done. Indirect transfers of shares, which I take a view, it's not taxable under DTAA because I don't cross a because I cross, say, a 50% threshold, but treaty is worded in such a fashion. Grandfathering provisions, India, Mauritius, India, Singapore, DTAA, shares were acquired prior to 31st. We need to first take the law head on because it is possible there may be certain slippages. In spite of best of the event, I would be missing the flow. I mean, in the sense that in spite of best effort, I could not have got 10F. Two options possible. Now, if you don't have 10F, the tax rate is 21%. If it is a gross of tax liability, higher percent, what do I do? It's with this background that we are dealing with 10F and Rule 21AB. Of course, not an amendment by the Act, but something which is still nonetheless very, very recent. There are two possibilities which are there. I adhere the law in absolute manner. I say 10F not available. If tax liability is on me, I gross it up. 6 years down the lane, some decision comes up that this requirement was bad in law. And therefore, I regret that to the extent of TDS or the extra tax which I paid, I eroded my PL. Therefore, one will have to understand what is the literal reading of law and then try to see what is the practical outcome and what are the practical situations. The requirement which is prescribed under section 90 subsection 5 is Rule 21AB requirement. Rule 21AB requires to give you certain doc information, status, nationality, TIN, what is the period, and address of the assessee. Most important is the sub-rule 2. Sub-rule 2 says that assessee may not be required to obtain the information or any part thereof referred to in subsection 1 if the information is contained in the TRC. Now, when we go through the various TRCs, what one finds is that there are two informations which will not be there. Above status, there is a PAN, PAN, and then there is a status. Now, to me, status, that means are you an individual, company, firm, is a creation of an Indian statute. You should not read it in a very, very stringent manner that look, out of 6, 2 were not there. What was 2 not there? PAN and TRS, PAN and status. Perhaps one should read this requirement as applicable. Now, when we do the survey of all the TRCs, one finds barring 2, 3, maybe Ireland, Hong Kong are some of the very, very borderline cases which does not give address. USA gives everything, but on the first page you will not find address. It is necessary that you call for the page 2 of the TRC because page 2 is also which is certified by IRS, where all this information like address, etc., is all forming part of the TRC itself. So therefore, on a plain reading of the law, 221AB states that therefore, on a literal reading, you don't need to obtain 10F. If I don't need to obtain 10F, the question of digital 10F does not arise. One. Then there is also a requirement that you look PAN. You should have obtained PAN, but you don't have PAN. If I don't have, I don't have. It's not there, right? It can't be mandated. PAN, the law says here two exceptions. Who does not have PAN and who is required to obtain PAN. Section 139A says that for the people of income chargeable under the Act. Two controversies, make available in the treaty. I am rendering some lawyer services or some kind of technical services, don't fulfill make available requirement. 0 is the applicable rate. Question is that then am I required to obtain PAN or am I not required to obtain PAN? AAR in the decisions dealing especially with India-Mauritius Treaty has made an emphatic statement. If the income is not chargeable under the Act per se, and Act would mean Act read with DTAA, then you are not required to file the return of income. If I am not required to file the return of income, then PAN itself becomes a too procedural requirement. Perhaps reasoning can be borrowed to make a statement that I may not be required to obtain PAN. Second thought is that look, treaty benefit is not absolute. You need to file the return of income, come clean, let the tax authorities get a chance to evaluate. Are you satisfying all the particular ticks which are there, the PPTs, the LOBs of the world, the beneficial ownership of the world, so on and so forth. Then only you are entitled to treaty benefit. So the chargeability needs to be looked at, would mean Act minus treaty. Two views possible. My view is that if the income is not chargeable to tax, be it because of make available or any other beneficial provisions under the treaty, India-Netherlands Treaty, equipment fund, India-Ireland Treaty, aircraft leasing, then in that case concerned, this requirement of obtaining PAN is not required. 30th September extension applies. What if I come to the next month, October, and these extensions are not further? In that case, in my view, 21AB itself comes that if TRC has all the requirement, all the data points, in that case, you don't need to obtain this particular 10F, and therefore digital 10F does not arise. One also needs to see the context because there are certain indicia which will ultimately help us in this particular law. This has been issued under Rule 131. Rule 131 is genesis under Section 295. 295 is only for the purpose of giving effect to certain provisions of the Act. Treaty, that means 10F forms part of 90 subsection 5. So therefore, 90 subsection 5 deals with treaty. A subsequent legislature, a subordinate legislature does not have a power to override something which is nothing but an unequivocal commitment which is given by India and enshrined under Section 90 subsection 2 and a promise which is given in terms of availing the treaty benefit. Again, this would amount to some kind of a treaty override. Vienna Convention says the treaty needs to be interpreted in good faith, along with ordinary meaning to be given to the terms and their context in light of object and purpose. Now, a 10F, a bona fide 10F, and one would believe that those are bona fide 10F. A 10F which is given in manual form does not get any higher value merely because it is given in a digital form. Yes, from a government standpoint, you are collecting certain information. The process of 10F requires you to upload TRC. but that is something which can be done differently. It's something which is an information gathering mechanism. You can't have a provision which then denudes or takes away a right of a treaty benefit vis-a-vis recipient distance. There are decisions, and we read SCAP's industry, which says that this amounts to a TRC, a requirement of TRC amounts to treaty override. Then a 10F, which is just in a digital form, will not have different conclusion. Then this would also amount to a treaty override. There have been instances in 206AA, pre-amendment, pre-subsection 7, where the law says that 20% is the withholding rate if you don't have a permanent account number. A lot of non-resident entities did not have a PAN number in India. The question therefore was that whether 206AA overrides unanimously, except one AR in case of what was that, Airport Authority of India has taken a unanimous view that treaty overrides 206AA. The law in case of the High Court, the Delhi High Court in case of Denisco 404 ITR has gone one step further. They have read down the law. Reading down the law is something where the law is so perverse or so against the normal legislative convention that the law has to be read down. So 206AA, the law was read down. Now, therefore, one can make a statement that Rule 10F ipso facto will not have any other conclusion. We also have 206AA subsection 7, which says that fine, you don't have PAN number, don't take PAN number. For what? Payment like interest, capital gain, royalty. But give me certain documents. Which are those documents? Those documents are almost identical to what is given in 10F. Give me the 10, give me the address, so on and so forth. Give me the email ID, right? Give me some contact number. Now, if there is one part of the legislature, which is what, 206AA, subsequent to subordinate legislature is rules. Can a notification have a power to override 206AA? Because effectively, to get a 10F and to follow a notification, this becomes redundant. I necessarily need to obtain PAN. So this is one more argument to say that the wires or the legislative competence within which this notification should have been issued is breached, and therefore this should have been shot down at a right case concern. So this was on digital 10F. Practically, what should you do? My view is divide this in 3 to 4 buckets. If I have got entities which are my group companies for which either I file 3CEB or I file return of income in India, there is no case, get a 10F. Possible that the directors would be non-resident. You can get a limited power of authority, get that limited power of authority and get the 10F and end the chapter. Tax liabilities on recipient, what do we do? Inform the vendors. Ensure that in your agreements or in your process or in the guidelines which one gives typically to a procurement team, this is stated very clearly that if liability is on you, this is what is my law, whether you like it or you don't like it. If they don't give and the liability is on vendor, deduct tax at an applicable 21% or whatever. If the liability is on me, and the recipient says that, look, I am only going to give this much. I don't want to register at all in India. I don't care. Then in that case, one will need to read the law and make us come to a conclusion, perhaps, that this should not be read as mandatory. A manual 10F is also good as long as other qualifications or other eligibility criteria are met. And maybe there can be a case of litigation. One will have to see the case, how it works. Practically in 201 proceedings, one sees assessing officer insisting upon TRCs, no PE declarations. One have not seen too much insistence on manual 10F. I don't know whether the tendency will change that, oh, because you have not got in digital, I reject treaty benefit 20%. My additions or my overall requirement is met. I agree that you had a tribunal decision which was covered in your favor. To the extent that I agree, you have got a DBS decision. To agree that in your case only you had a Supreme Court decision, but the law has changed. There is no Form 10F available. I am denying. The history repeats. Possible, but nonetheless, on merits, I would strongly believe that this is something which is not likely to or would achieve the same fate as 206AA is concerned. Transfer pricing. Why it is important is your residuary article, Article 12.6, 12.5, as the case may be. This article says where by the spatial relationship between payer and the beneficial owner or both of them, amount of royalties or fees for technical services paid exceeds the amount which would have been paid in the absence of such relationship. The provisions of this article, and please note the next sentence is very important. The provisions of this article shall apply only to the last mentioned amount. In such case, excess part of the payment shall remain taxable according to the laws of each contracting state, due regard giving beyond to the other provisions of the agreement. Essentially, what it says is that if there are any special relationship, you should have paid $1,000, but you have paid $1,200. Under an FTS article, you or say royalty, you have deducted tax at 10%. The treaty rate will apply only to the extent of arm's length price. Anything which is above will therefore not be governed by the beneficial 10%. The question comes up is why such provision? Perhaps there one believed was that under the garb of lower rate, one is moving the profits, one is moving the shifting the profits from country A to country B. And that is what one needs to stop. Can you take an argument that fine, this is dividend according to you, give me still 10% because I am still beneficial owner. If I am beneficial owner for royalty, I will be beneficial owner for dividend. Can you take that an argument? Answer is no. OECD commentary comes up with a very, very emphatic kind of observation that it provides that in such a case, the provisions of the article applies only to the extent of last mentioned amount, and the excess part of the royalty shall remain taxable according to the laws of the two contracting states, due regard had been to the other provisions of the convention. The paragraph permits only adjustment of the amount of royalty and not reclassification of the royalty in such a way to give it a different character, example, contribution to equity. So therefore, the commentary is not permitting a recharacterization. Therefore, if your transfer pricing policy is not in accordance with or is not accepted at a higher level, there can be typical issues which will come up. And we are in a maze of transfer pricing controversy where a lot of decisions are dependent upon the apex court. Let's take a royalty. Today, it is not known whether an aggregation approach is correct, whether a transaction, that means a separate cup is okay. One is not known whether I need to do a search on a royal stat or some other third-party software, or I can make a statement that ultimate profitability which I am earning, when you compare with my peers, I am earning more. So this is a TNMM or transaction-based approach, and therefore you meet the arm's length standard. Within the royal state database, there are a lot of assumptions which goes in. So if tomorrow they make a statement that you are paid at 1.5%, but the arm's length price should have been 1% concern, then in that case, I would have deducted TDS, and this conclusion would have reached after 7 years, say a tribunal. And one would believe that this is a question of fact, that what should be the rate at which one should have made a payment to the extent of excess. Earlier, no attention was given. Perhaps there was a reason that default rate was 10.90. Perhaps there was a very lenient approach which was taken. Now, apart from the TP addition, you may be questioned making a statement that look, no, the default rate or the addition on the TDS should also be this much amount. If you are a payer, I invoke 40A1A, and that's how you move you take it out. If you are recipient and you have taken a particular treaty rate, then in that case, in your own TP assessment, and perhaps I don't know what happens if the payment is challenged on the flip side or the Indian entity, what consequences will come up. We are also told, pursuant to BEPS, that the approach needs to change. There is a DEMPI which comes up, that the rate of a value or an IP should be based on who is developing it, who is enhancing it, who is maintaining it, who is exploring it, who is protecting it. Now, based on DEMPI, which will depend upon cash flows and many variables, if adverse conclusion is reached, that is an issue. Marketing intangible, it is not settled. Today, the matter is before Supreme Court in terms of the AMP cross charge. One will need to see, at least today, the precedents one way singularly is indicating that bright line test, unless there is an agreement between the two parties, not something which is accepted. Management cross recharge. Now, management cross recharge requires a very, very detailed exercise. Number of elements goes into recharge. What law says is that first create a benefit test. Prove that you are benefited. If you are not benefited, then in that case, even though you take a view that these are make available, nothing is chargeable to tax. But ultimately, if it turns out that the payment is higher than what otherwise a transfer pricing or an arm's length payment was, to the extent of excess, you would be governed by the domestic law in India. In the management cross charge, there may be duplicated service. There may be certain shareholder services. Let's take that I've got a global CFO or a global board, and they sit regularly. Some costs are getting apportioned. Certain secretarial costs are getting apportioned. Certain costs which are in terms of those various other periphery department, one needs to see whether my arm's length principles are or the cross charge is in accordance with arm's length. Group cost, what are the drivers? If they change the driver, and driver at this moment is tilting more towards India, if in the Indian TP assessment they take a view that you have paid more, the driver should not have been headcount in a software, there should have been number of download, and a particular authority upholds that view, then in that case, again, the consequence impact would be on the 20% rate. AP and MAP applications. Now, this will be a very critical factor. Why? Now, just recently, and some very senior professionals in some of the groups, and rightly so, were discussing that there is a Supreme Court decision which says that when it comes to certain comparables, that can be challenged before High Court, but underlined it has to be only in a case when the finding of fact was perverse. What is perverse is a very, very detailed exercise. Somebody may take a view that I want certainty and want to go to AP. My APA authorities, maybe India was swift, maybe Indian authority, as they are typically would try to come to action in a very short time, but other competent authorities was not available. They conclude after 5 years. They conclude that for a CCA or a common cost service centers, etc., the margin should have been cost plus 5%. Why? Because there is other party also to that transaction. Okay? So we heard a fable, right, of a hare and a tortoise. While hare runs fast and wins the race, the tortoise ultimately wins the race, whereas hare ultimately loses the race. In TP, one has to go slow because it's both the parties whose interest needs to be taken care of. So therefore, in tomorrow in a TP assessment, in an APA ruling, it comes up that 5% is there. They typically invoke secondary adjustment as well and tells that you have paid 10%, bring that 5% back, pay it along with interest. There is one more consequence that if you would have deducted at a treaty rate, to the extent of 5%, what will happen? That can be a very, very difficult consequence. So to go or not to go in a APA, this is one more rider which one should take into consideration. The last point before I stop, we were told, and many people cherished, that we are giving you an exception to all the non-resident entities, that if the TDS is deducted in accordance with the provisions of Chapter 6, to which 195 is also party, and the rate is not less than the rate prescribed under the Act, that means the Chapter 6B, sorry, 17B, then in that case, non-residents are not required to file return. At that point, 115A used to prescribe a rate of 10%. Now 115A prescribes a rate of 10-20%. So if you are taking a treaty benefit and claiming 10%, you need to file the return in India post this particular amendment. This is something which is a very, very major change and will require, of course, this amendment is effective from the subsequent year. So last year's, even for year-end provisioning, old rates were applicable. 206AA, it works on a rule of 3, whichever is higher. Rates prescribed in the relevant provisions of the Act. 195 is part of the Act. 195 does not prescribe any rate, but it merely says you deduct tax at rates in force. 237A rate states what are the rates in force. Two options. If you are governing under treaty, DTAA rates. If under the Act, which is prescribed under Part 2 to the Schedule 2 Finance Act, which is nothing but the Domestic Act, added up with cess and surcharge, or the rate of 20%. Judicially, it was held that 20% is absolute. It need not be added by cess and surcharge. But now, vis-a-vis 206AA, because 20% will be added by cess and surcharge, it may be as small as 20.8% or as high as 21.84%. Then it would be this rate which would override Section 206AA rate. That was all from me. I thought some of the issues and more periphery issues which we can deal under the bigger amendment which is there. For me, it has been an excellent learning experience. Open the floor for questions. TRC does not contain status, but the same can be made out from taxpayers' main. Do we need still 10M? In my view, this is overriding. Of course, status can be known from the name of the company. Therefore, according to me, if other requirements are concerned, there is a view possible. Booking.com is a hotel room booking website, is based in Netherlands, made booking for Indian. Booking.com has a PAN bank account in India. I think fact specific, whether no PE certificate is required, fact specific. Ideally for every remittance which you make, just not no PE, all the ticks in terms of PPT, GAR, etc. would be required. The law on the declaration is now like this. Let's take a case that I meet you and I make a statement that I am not suffering from COVID. The other person agrees that yes, he is not COVID. This is the law of bona fides. Certain anti-abuse provisions are too subjective and factual in nature. Practically, it is not possible for us to reach a satisfactory conclusion, and hence the NR declaration should be taken in a very, very robust manner. Yeah. Yes.
So Jinal has raised a hand.
Yes, Gina, continue.
Please unmute yourself.
Unmute yourself. Yeah, you can hear me?
Yeah.
I can hear you, Gina.
I can hear you, Jim.
Yes.
So my question was, you mentioned that if a make available benefit is taken, then there is no return filing requirement for a non-resident in India.
That's a view possible.
View possible, yes.
But if he is your ACB has nothing to do with taxability. So I'm just trying to make that.
Okay, but then this is the rate is 0, which is less than 115A rate. So how do you?
But it is 0 for the simple reason that the treaty section 90 subsection 2 allows me to do it.
Okay.
Next.
NR
who has paid to file form 10 online, or from there is an extension. If NR is a PAN in India, the notification does not give you any extension. Ideally, they should obtain a digital 10F. Have a strange case where TPO has reached, and of course, when we take certain views, those are subject to litigation. Let's take a case of dividend where somebody is claiming treaty benefit. Of course, you will insist on digital 10F because the stakes are too huge. Have a strange, okay. If TRC does state, I think we have done 4 or 5 questions only, which I saw.
There are 3-4 questions in the chat box also. Shall I read?
No, I will. Let me try. Where is the chat box? Okay. Sir, earlier we could get a 10% cess surcharge under IT Act while applying 197 certificates. See, now the 20% EO does not accept our argument. Litigation times increase. Appreciate. Is withholding tax liability for commission paid to UAE if he is a 10F? See commission payment. Let's just pause here. Under the Domestic Act, what do we have? We have 3 provisions, and we need to be very, very mindful of the 3rd provision. First is it royalty? Is it fees for technical services? Courts have unanimously held commission has nothing to do with FTS. I am only on a pure commission agent who is procuring. He is not rendering so much of services. Services are limited: coordination with client, follow up with client, ensuring agreement is signed, delivery happens in time, and follow up with payment. Pure typical commission. Then courts have unanimously held that this is not FTS, and that's the end of the matter. Not a royalty, surely yes, there is no usage of IP. Stop there. Act income is not taxable under the Act itself. Move further. You have got a significant economic provisions which is there. Now that provisions has nothing to do with what are some of the taxable criteria. Is it managerial, technical, consultancy? That is a payment based. Are you dealing with a resident of India? If the commission exceeds 2 crores, 100% you need to take TRC, because SCP liability can be steep. Theoretically can be steep. There are other things also on SCP, I would reframe, but theoretically can be steep. Should an NR who has obtained PAN but does not or should surrender the PAN before 30 to STM? Sir, this question is very well made, but practically there is a checklist. Have you filed return for so many years, etc., etc.? Then only PAN will get rejected. Otherwise, you need to be in this classified non-filers or dormant kind of the companies which was there where all the PANs and the companies was struck off. But nonetheless, it's not that easy. Some foreign companies are stating that they are covered by EL and don't deduct tax. So in that case, we need to check and how do we proceed further. Sir, without facts, it is difficult, but I am aware some of the companies make a statement that for softwares, we are so on and so forth. According to me, go into the services. understand whether the services are a string web service or there is a software as service. If software as service, which treaty you are dealing with. If there is a make available clause and other ticks are met, then a view is possible, not taxable under the equalization theory. If you are from a country which does not have any favorable treaty, or there is a deficiency in documentation, in terms of priority, equalization is number 2. The act is an overriding title. Just hold, I'm trying to screen it. Just hold. Certain TRC does not mention the tax year or tax period, but are issued on that day. I think she is referring to UK TRC. See, in UK, US has calendar year, UK only has date. Now, but you go and read the HMRC guidelines. HMRC guidelines clearly says that it is valid for the period of 1 year from the date of issuance. You keep that HMRC guidelines with you, because we have not seen so many of such TRC. TRC of the year of deduction only to be considered, or should we ask the year of payment? This was some question which we just encountered some time back. Now, see, you are in a month of April. There are two things which are happening: year-end provisioning and payments which are taking place. At the time of year-end provisioning, and it is possible some payments are delayed by 2 to 3 years for whatever reasons. Then in that case, question comes in which year TRC is important. Two things. One is the way in which this TDS wing issues notices. It is based on CACs. So they don't consider the year in which you are debiting in the books. Technically correct is the year in which you are debiting in the books. You are putting that 10% as a TDS and paying to the government. That should be the year of TRC. Practically, this notices are based on payment basis. So they may insist. You will have to convince the officer conservatively, for which consultants are not required, that take both the years of TRC. Any update on continuing of 194 LCLD? No update, sir. I mean, no update would mean it's not at least given in a very positive way that they will continue. They have powers to issue notification. Once is what happens. Tax return filing is responsibility of NRI. If they don't file nor pay tax different, what would be the consequence? Very simple. Section 163 of the Act makes a payer an agent of the non-resident, and then the liability is quoted. A debentures covered by 194 LD would refrain from commenting upon it, because debentures can be NCD and so on and so forth. It's not that straight as an answer. So I think, Kirit, I think all questions are. Many a times foreign party makes a statement that the government does not issue TRC. Any reference material available in public domain where we can check the country for not giving TRC? Unfortunately, I have not encountered a case where publicly a country will say, I don't issue TRC. Many a times where you do is the counter check, that how do I get TRC in Russia? If there are some links or something, you at least know that kuch to likha. Beyond that, you have to get declarations, get email confirmation, but don't stop there. Get some other documents beyond a VAT registration that you are still a resident. And then the SCAPS industries, this declaration, etc., will support you on this. So I think that takes care of three more questions. Yes, the presentations will be circulated. Surely, yes. Any effect on STTR rules? See, this rule needs to come into picture as law. Before that, it's difficult to comment, but some reading suggests that STTR, which is a BPS rule, cannot exceed 9%. So where is the 20% coming? But I would again say I'm not commenting upon this. Perhaps my reading is yet to reach STTR.